everyone, and thank you all the speakers. It's been an engaging and pretty learning experience for me. Frankly, I have a few questions that I'll ask on behalf of the audience here, and probably we'll also take questions from the audience. I'll start with one of the most important aspects that was also already asked by one of the individuals as to what are the typical pain points that you see as part of a transaction when you actually go in to advise your clients, right? What are those pain points that you see that you need to solve for your clients? And we'll go one by one, we'll go in the cycle of the deal itself. Like for example, Jyotirmay, when you actually meet a client, right? I'll cover both the aspects of buy side and sell side. So we'll do buy side round first and then we'll do sell side round. When you meet a buy side corporate who's looking to find an asset, what are those pain points that you see at that particular stage that you think as an advisor we need to solve for to be able to make an impactful pitch that you become the advisor than anybody else?
Yeah.
There's a mic there.
Yeah.
Yeah.
So, okay. So, for see the corp dev guys, essentially the M&A corp dev guys who run the deal from the buy side, right? They end up seeing hundreds of deals and million bankers and so on. Where I think they get stuck is at every stage there is a different, there are multiple fathers of a deal. There's a business unit head who has a decision-making power. There's a CFO who has a financial IRR hurdle to be crossed. And there's a chief strategy officer or somebody like a CEO who would be probably looking at it on a high level. Now what happens is I have seen most of the 90% of the transaction doesn't fit the criteria because it never fits that so-called perfect deal that they want to achieve. I will take an example of IT services quickly because at this point in time, there are three buy-side mandates that I am running from reasonably good corporates. Now, you want a Salesforce company which is healthcare focused. Tell me which Salesforce company will only go ahead and cater to healthcare client and not to manufacturing and not to technology. So the criteria that the CEO or the corp strategy team themselves set for, or the business team sets, is usually a very impossible criteria to achieve.
No, do you say that this is a situation in Indian corporates, or is it like a global kind of a problem? Because I think what you're trying to point out is the strategic misalignment between the managements, like the interest of CFO versus the corp dev versus the sales head versus the CEO, and the kind of strategic outlook of the board of directors itself, right? To say, I need to find an asset which is Salesforce only for health tech. Yeah. Is it more of an Indian problem statement or is it global problem statement that you found?
I honestly do not, it's not as if, for example, it is a global phenomenon.
So what is the pain point that as an advisor you need to go with? Like, is it our advisor's role to tell them that you are looking at a wrong strategic outlook? Or do you say, yes, I can find you something and find something which has an element of health tech and then present it to them?
Both. But having said that, as an advisor, our job is to show them the reality. They sit in their own castle in the air, formulate strategy, the board comes from McKinsey and so on and so forth. Honestly, the company, if you have to do a transaction, if you're acquisitive in nature, if you have to get that leap in growth, you have to look at what is available rather than what is ideal. Okay, and as advisors, it's our job to show them the mirror and show that, okay, these are the assets which are available in the market. Okay, so and we should not be too reticent about it. We should be pretty aggressive. And in fact, we have got results out of that. I know it for certain that we have been able to push more horizontal Salesforce asset. It's an example that I quoted not out of thin air, but something like that happened. There's a large healthcare focused BPO who only wanted to look at pair companies, like other BPM companies which will be working with the payers in US. It's absolutely an impossible proposition. So there has to, what we showed them is companies with decent amount of payer mix, but not more than 30-40%.
So in essence, what we are trying to say is, as a pain point on the buy side, typically is that target screening,
yes.
strategic alignment of theirs to strategic trends. So Aditya and Jayashree, this is a question for you. When say a target is actually found, right? Now on the buy side, let's discuss on the buy side. There are two scenarios. Let's take an Indian holdco, Indian corporate trying to do outbound versus inbound, like in India it's a domestic kind of a transaction. That's the first scenario. Now target has been already found. What are those key factors that you will consider in your mind while advising your client as to how to structure it at that stage? When a target has been found, let's take an example of an outbound, say a geography which is, say you found a target in US, an India co looking at a company in US versus an India co looking at a company in Cayman. Now, what are those key factors that you'll have in your mind while advising your clients as to how to structure it? What are the typical Q&A that you do to get to answer for them? Because the biggest pain point for them is going to be, how do I make this investment successful? Where is it that it's going to be tax efficient? So what are those key questions that you will look for when you meet them?
Sure. Assuming Jyotirmay convinces the buyer to buy that asset, then we go in. So typically, again, as you said, it is Indian promoter buying outside India. Okay, most of the time, okay, the tax laws of the other country we may not know, right? But the expectation from the Indian buyer is that how efficiently I can buy this company or an asset. Now, what does he mean by efficiently buy? Okay, do I need to raise? Can I do a leverage buyout? Okay, can I raise funds? If I can raise funds, can I get a deduction of the interest what I pay? Where should I raise funds? In India or outside India? Then how do I say, once I do that, once I kind of, answer that question, like, yes, you need to go for a leverage buyout, from where should I buy? Directly from India to US, or do I need to incorporate a company in between, wherein, from a tax perspective, is it better to finally, when I exit, it will be more efficient, or in the interim, when I'm getting the dividend or any kind of repatriation from, say, US, does it make sense to have a direct holding, or should I have a intermediary holding company between US and the Indian buyer? So these are some of the questions. This is at the first meeting when we go. Ideally, we should have some knowledge, because you will not be able to comment on US tax or any Cayman Island tax, because that's a very, very specific domestic issues, which probably you will have to lean on your colleagues in that particular country. But from an India perspective, it will always be a question, do I need to go for believe me, none of the Indian promoters will go without leverage buyout. They will raise funds to buy. The question would be where I should do the leveraging. Should I have an intermediary company for the purpose of getting the money back? And also, when I do the exit, will it be efficient? So this is the first meeting that, we need to be prepared ourselves, irrespective of any jurisdiction. They are, and also they will, in the most of the time what we have seen is, okay, this is my first acquisition. Okay, I may have multiple acquisition in the future. Tell me, keeping in mind, if I have this plan, what should I do? It should be a linear, kind of a flat structure, or should I have, like a holdco, and then that holdco is used for the purpose of, buying other companies in different jurisdiction. And holdco, again, it's not just simple holdco, right? Then you have to think about, can I leverage in that holdco, or can I, list that holdco eventually? All those considerations, at least you should have some pointers to talk to them, because otherwise you are going, I don't know whether, then I think probably Jyotirmay will go to some other consultant to get tax advice. But at least these questions you should be having at least, some knowledge about these structures.
So while Aditya's answer from a tax perspective, I think what becomes also important when you're determining what that jurisdiction should be is understanding the overall plan of the client, right? Because if they're doing one acquisition versus multiple, so somewhere that also becomes an important question to ask. So let's say if they're looking at multiple entities and acquisitions in Southeast Asia, for example, so then maybe Singapore is the jurisdiction you will take. If you're looking at Europe, maybe some country in Europe, but if they're doing a one-off, then the answer is a little simpler. And again, like we discussed in the past, if let's say we come up with a jurisdiction, one of the questions we do ask them is whether they have any entity already in that jurisdiction, right? Because substance, all of that comes into play later. So that also becomes important.
And does it differ from one geography to other? Like you are acquiring a company in US or North America versus you are acquiring, say, in those old days
Havens.
tax favorite countries like Cayman Islands or say your Mauritius. Does it differ? Like, do you do it directly from India, or do you actually create a create a special subsidiary based on some other geography to be able to help? Does it actually matter which geography the target is based out of, or is it agnostic?
No, it does matter. Like I said, so if the focus is, let's say, Southeast Asia, then you would look at something closer.
Any reason for that? As to what's the reason behind, say, Southeast Asia need to have, say, probably Singapore is the best country to have a entity.
So
Middle East, say, Dubai is the best option. Or if you're going to, say, Europe, you'll have some one country that becomes the best option. Like, what's the rationale behind it?
So I think it's more tax and commercial in that sense, because if you're doing a services business, maybe not so much, but if let's say it's a products business where you need like physical movement of products and people and all of that, then you kind of also look at it from a vicinity perspective.
For tax, it's agnostic then. Tax it
Tax
doesn't
again
matter.
gets driven by the tax treaty, right? So that would
That will be the
govern more
governing
of,
factor.
more of it from a tax.
So from a tax perspective, I think because of all these BEPS and all, now it doesn't matter whether you have a intermediary holding company or not. It's good to have a flat structure. But say if you want to do a leverage buyout, or say in Southeast Asia, maybe then you can consider Singapore to raise the debt, because definitely it will be much cheaper than raising debt in India and then infusing into Singapore. So might as well have a company in Singapore, raise the debt based on the guarantee given by the parent company, and do your acquisitions.
Yes. So Rajan, I'm moving to the concept of due diligence right now. Indian company will be getting reported on Indian GAAP. Now, outbound transactions, so US entities on US GAAP, or if you were to go to European countries, it's on IFRS. How critical is it for us to do an alignment of GAAP? Because the Indian business will understand and then get reported on Indian GAAP basis. So does different gaps in different geographies make any impact on the way you will do a financial due diligence, or is it actually not an important factor?
No, definitely it's an important topic to discuss, especially in when we are doing a diligence on multi-jurisdictional kind of a scenario. The gaps of each of the entities could be different for that matter. So hopefully when there is it's from single group, there is a possibility that it's a consolidated financials are there which is aligned to one particular gap. So that will help our problems to some extent. But if not, then it is a bigger problem. Then you will have to deal with different gaps, analyzing each of the entities under different gaps, etc. So there could be gap differences itself could create certain issues in terms of ascertaining what is a normalized revenue or a normalized EBITDA, etc., etc. Or even things like accounting for debt or accounting for certain intangibles. It could be different under different gaps, so it can create an issue. And alignment, even from finally, even assuming that you have analyzed everything, done the gap difference study, becomes very important, because at the end of the day, after the acquisition as well, if the acquirer company has to consolidate that business, then they'll have to naturally align the gaps to their reporting standards. So accordingly, the impact of that should be analyzed upfront itself, because you may assess value or any other things based on the reported gap of the selling company, or the target company. But when you actually merge or consolidate into the business and present, your EPS could be very different from what was what you envisaged at that point in time.
That's very important question, right, to ask. Jyotirma, this is a question for you. Like when the term sheet is signed, and term sheet is signed typically, just to clarify, when there's an intent offered by an investor to or a buyer to a seller that I'm interested in acquiring you. Assuming an Indian co trying to acquire a company in US, right? I'm sure EBITDA, for instance, is what you had also referred across the presentation, becomes a very critical factor. Now, EBITDA is calculated based on a lot of accruals, right? And methodologies can differ between the two gaps. Is there an alignment on the gap upfront at the term sheet stage? Say an Indian company acquiring a US GAAP company, as to which accrual methodology will be used, which accounting gap will be used? Will we use the Indian GAAP or will we use the US GAAP? Because any disagreement there can also create a lot of dispute once the diligence process starts, right?
So I'll answer the question in two parts. In terms of clearly stating at the term sheet stage itself which accounting standard it would follow, that is pretty clear. There is, at least I haven't faced any issue with that as of now.
So typically what? So Indian companies acquiring US companies, do they say IGAP or US GAAP?
No, US GAAP.
US GAAP.
US GAAP. Okay, US GAAP, and more or less people want to keep the accounting standards intact. You would not want to restate the entire accounts with new accounting standards simply because you want to do a transaction, because nobody will do that, right? I mean, they will not. There is no guarantee of the transaction happening to merit such a humongous exercise. But I think since you are asking about challenge, I'll just segue to that the actual challenge is not in the standards. The actual challenge is in two things. Number one, to define the real concept of EBITDA itself. What falls under EBITDA, what doesn't fall under EBITDA. There is, I don't think so, since I'm not a CA, I don't think so there is any copybook legal defined definition of EBITDA either under Indian GAAP or US GAAP, right? I mean, it is a derived concept. So agreeing on that concept itself is a challenge.
But I guess at the term sheet stage, EBITDA's definition is not agreed for. And that's an EBITDA's definition typically gets agreed when a due diligence gets completed. After a third party firm actually has reviewed the financials to actually find out what will form a part of our EBITDA definition and what will not. Like culling out non-operating expenses, which you, for instance, called out. Any accruals that will have to be taken into EBITDA versus not taken into EBITDA. For instance, let me take a simple example, and Rajan, probably you can come in, right? Factoring cost. Now you have a receivable which needs to be collected. The target company goes and factors it. There is a finance cost towards it. Cash flow is already converted. It has gone out of working capital. Money is already come into my cash. I have paid a finance cost which comes and sits in my finance cost. Now, will it form part of EBITDA or not? Now, these kind of questions will typically come up, right? And so, who actually makes that call? Is the guy who comes and does diligence, and what's your view on it, Rajana?
Not necessarily. Sorry, I mean, I'm again not fully disagreeing. I'm just partly disagreeing. Something as subjective as there are three promoters. One comes and says that I only play golf. You check how many times I have come to office. I don't come to office. I have a second line of management who comes and does all the work. Then another promoter says that once in a while I come. But now, how do you define those subjectivity and say that the promoters are all drawing salary of 2 to 2 crore or whatever consulting fee? Is that necessary to be considered as a part of your cost, SG&A, or is it not SG&A? The promoter will always come and say not SG&A. But while asking whether you are important for the business, they will go and blurt it out in a meeting saying that, I mean, between three of them, he knows everything. The moment you say he knows everything, that automatically implies that he is important for the business. Without him, the business won't run. So all these agreements, which are highly subjective in nature and not defined in any accounting standards, that's where bulk of the agreement has to happen.
Okay.
After that, the ones that you are mentioning, right? Like again, something like an R&D cost. In the same breath, the promoters are saying that we have been doing R&D for last 5 years. We have been building products. Our products are what gains us entry into all the large insurance companies. But You cannot, but then I want to capitalize it because it is not an expense, it's R&D. Now, and these are not small elements, these are like 1 million, 1.5 million, a huge impact on the final valuation, 7-8 million impact with each 1 million here, right? So how do you account that? That happens DD. During the LOI phase. So I hope.
But all of these terms and agreements are already laid out in the term sheet.
Not fully, but at a 30,000 feet level, at least the most important items. Like for a company whose EBITDA is book EBITDA is 2.9 million. If I'm saying that 1.5 million is on R&D capitalization, then definitely. But the smaller 200k, 200k, no problem.
So Rajaram, when you do a diligence, right, do you actually use the definitions and the agreements that have already entered into a term sheet before you start, so that when you do your exercise, you're aligned to the way the transaction is going to be constructed, or do you do the whole diligence par for course to find out all on everything about the quality of earnings and then let the client decide how they want to read it?
So it works in both scenarios. Like in most of the cases, as Jyotirmoy said, maybe there is no defined terms for what is EBITDA, normalized EBITDA, or net debt and working capital. Many times it is defined after the diligence is done, because there will be a lot of inputs which is given from the diligence. Then both the parties sit across the table and then define what these terms mean. But when we do the closing procedures where the deal is actually closing, and then we do the completion accounts, or when we drop the lockbox, etc., lockbox accounts, that time this definition will become very critical, and then we'll have to follow the definition to the T while computing these, what is EBITDA or whatever the defined term. It could be net current assets, or it could be, net debt, or in some cases it could be net assets also. So whatever is defined and agreed commercial terms in the transaction document, that is what will be following in the closing stage. In the initial stages, it is generally we propose, okay, these are all the normal items which can be bucketed under these categories, and up to the negotiating table it goes. That's it.
And a term sheet says, Aditya, do you actually get involved to see as to what should the structure be already, or is it open ended at term sheet stage? You don't recommend should it be a share swap, cash transfer, what percentage should be a swap versus transfer? All these clarifications are already provided, or is it typically kept open in an?
No, I think So we do mention about structuring, but it is not closed. It is open, but we do touch upon, like, we may have, I've seen different kinds of term sheets wherein we've given all the options, and based on the due diligence findings and all, we will probably select one of these options. We've also said, very, very simple line, saying that it could be a share or a business acquisition depending on the, facts of the case, or depending on the findings of the due diligence. But having said that, definitely we will at least touch upon structuring in some way or the other, so that it's captured in the term sheet. So it's not like we are going blind when all the things happen, because the expectation of the buyer would be, as the due diligence is progressing, you also start thinking on the structure. So somewhere I think the exercise is already done. But putting it on the paper, like a final one, we will do it later, but we will do something in the term sheet. We will not keep it blank.
But frankly, tell me one more thing. See, all the different kind of structuring that we discussed, right? Should it be a slump sale, or should it be an itemized sale, demerger, merger? Aren't these concepts actually applicable for domestic transactions? As far as your international cross-border transactions are concerned, mostly the transactions fall into your share transfer category, right?
Correct. If it is cross-border, yes, absolutely right. So then there is no, I would say, structuring maybe from a target perspective, maybe still there could be some play, but not from an India perspective, because that question of acquiring the business versus shares would still be relevant in a outbound deal as well. Because say if you are buying a company in US, and after the due diligence you realize that, okay, I don't need the company, I just need these assets, and it has happened, 1 or 2 cases it has happened. So the question of then we tilt towards the asset acquisition. So I would say it is still relevant, but maybe most of the time it will be a share deal, and we just close it on the share deal rather than getting into a detailed structuring discussions.
And then typically when most of the outbound transactions that I've been part of, most of the sellers, founders typically ask for earnout, and which is on the point which Jyotirmay also had brought out in his presentation. Typically, is there a tax issue for an Indian buyer when there is an earnout being asked from by a cross-border seller, or is it actually it doesn't have any cause of concern for Indian from the tax perspective?
Yeah, so it depending on who's the seller. If it is US, yes, we don't worry much because they will take care of it. But say assuming, okay, normally we will not take care of even if it is an Indian seller. But having said that, I think if it is an Indian seller, we will still have some visibility on what will be his tax implication, and we may come up with some other structure instead of say a pure earnout, maybe ESOP or something like that, which may sometime work out efficient than the pure earnout. But if it is a US person who is selling, US company or a US individual selling, then we don't get into, unless he comes out and says that okay, this will work for me better in a tax way, then probably we can think of. Otherwise, we will not get into that. Yeah, typically.
I'll move to domestic set of transactions. Jyotirmay, what is that one deal breaker that a buyer, Indian buyer, has to always look out from the corporate development or M&A side, that if found in a target, it should not be bought in India, domestic transaction?
So domestic transaction.
Domestic transaction. That's just one deal breaker that you think is a clear-cut no always.
Like I will give a very I'll give a very subjective answer to this. Nothing to do with the books. I have never seen any buyer being comfortable with promoters who are willing to almost like wash their hands of the business. The skin in the game. I mean, it's just that without even getting into due diligence, numbers, etc., it just leaves a bad taste in the mouth in the very beginning. I mean, why are you doing that? Unless and until the cases are exceptional, like the promoter is 70-year-old and wants to move on and wants to retire. Very clear case, right? But one-shot deals, when it comes from the buyer, it's fantastic. Many buyers prefer to do it. But if the seller comes to the market saying that I want to make a complete exit and I don't have anything to do with it, I will not provide any comfort regarding I have seen sellers which is sort of a challenge where sellers come and say that I have built the business up to 50 CR. Value me at 50, whatever it is. I will not even give you the projection, because if I give the projection, which in a way I understand where they come from. I mean, it's a double-edged sword. I am a seller. I give the projection. I say next year I think I'll go 50. Next year I'll grow 75. Then what will happen is the multiple that the buyer is going to provide me is still going to be 7 or 8 only. Maximum 8 ka 8.5. But they will tie that multiple they will use the same multiple, tie me to an earnout, which is based on the number that I have provided. And then the seller will come and say that, boss, if I would have, instead of providing 60 and 75, if I would have provided 55 and 60, I would have got 7-8 multiple instead of 8.5. But my probability of earning that would be 10 times more than the probability of doing this. This is an aspirational number, right? So, combining these two aspects, there are many sellers who are extremely reticent about providing any future outlook. But that...
And hence, I think in VC and private equity world also, they bet on the guy than betting on the business.
Absolutely.
Because as long as the guy is committed, the business
Absolutely.
is committed.
So anything which gives a hint that my skin in the game is not there post the transaction, any hint of that is a deal breaker.
How about tax, Jayashree? One thing that you find in your tax diligence and you tell your clients, please don't even touch this company.
I think if, at a very basic level, they're generally non-compliant, right? TDS compliances all over the place, they're not filing things. It just gives a sense that they're not really too,
but what if
worried
there's
about
more
it.
housekeeping, is focused more on, focused on sale and building the business, rather than, focusing on compliances?
See, typically, like I said, very rare cases that tax becomes a deal breaker, right? But having said that, I had one instance where we went almost all the way and something like deferred tax became a deal breaker because the two parties were not able to kind of come to a consensus on whether deferred tax was a debt or a debt-like item.
I think
It's
that's
as
a ve-
simple as that.
That's a very nice subject, and we
super
can
important one.
Yeah.
we
we
face
can
it
we
all
can
the
certainly
time.
let's actually touch upon that subject. I'm not sure if you guys understood the question. Should deferred tax asset be a cash-like, and deferred tax liability be a debt-like? So
Yeah.
that's the question. What's your view, Jayashree?
You're putting me in the spot now.
I think we all have our view. Let's go one by one on this.
So
And
I
we'll
think,
circle back to the question. Yeah.
so I think in that scenario, I think we said that it's more of an accounting entry.
Or is it your opinion will change based on on the buy side or the sell side?
Yeah, of course.
And if it is DTA or DTL in the books.
Yeah, of course. And I think in this scenario, the interesting thing was the buyer and the seller both actually wanted the deal to happen. It was the financial diligence advisor who, just kind of put their foot down, and ultimately the deal kind of fell through. So
No, but what's your opinion? Should deferred tax asset be a cash-like and deferred tax liability be a debt-like, or no?
see, while it is an accounting entry, but I feel it should be, because end of the day, it does impact your cash flows, right? So, I mean, you guys know better. So, but yeah.
Yeah, Rajaram, your opinion on it. And this is a standard interview question when we hire anybody in FDD. It's a very interesting topic.
Yeah. So let me put it this way. I mean, if I have to just look at it very technically, right? I'll tell like this. If, say, maybe in a private equity deal, right, where the investment horizon is only like say 5 years. In 5 years, they want to exit, and you based on your own tax reviews, if you believe that this unwinding of deferred tax asset or liability, whatever that is, if that is likely to happen, much beyond 5 years, then this is not really going to impact you much in the cash terms in your investment horizon period. So maybe you can just let it go, right? It is not a big item to worry about. But if you are a corporate guy who is looking at, and you know that you are going to be there in the long time, right? So, and this is definitely unwinding in a period of time, and this you can definitely consider it as a debt. Like again, eventually it's a commercial call to be negotiated, but technical point of view, it's a cash item eventually, because it is going to come and hit you in the current tax during the unwinding years. So it can be taken. Now, the other related aspects from the tax is like, say in the DD when you do, like obviously tax team will say, now your unabsorbed loss will go out. So then definitely to that extent, don't consider that deferred tax asset also, because that is gone, right? So you are not going to get any benefit out of it. So it's like you have to see some specific nuances and then take a call, because many times in the valuation also, you are carrying forward these unabsorbed losses or depreciation losses, etc. That means you have already given the benefit in the valuation. So there is no further benefit you require to give in the form of separately adding a deferred tax asset, right? Similarly for the liabilities, if all this is baked into DCF method, then already taken care of. You don't have to do further adjustments. The carry forward effect, if it's taken properly, then no need of further adjustments.
But Jyotirmoy will say that DCF is rarely used. People have a multiple in mind. SaaS business, India portfolio, he'll have 12 as a multiple of ARR.
Yeah,
That's the math. There's
that
no
is true.
DCF behind
Yeah,
it.
exactly.
Nobody can justify if they've actually considered assuming a strategy.
In such kind of cases, then it becomes a commercial call, and the specific nuances which I just mentioned, maybe it will become an input for them to decide.
Aditya, what's your opinion on this?
I think they've covered both the sides now. I don't know, but I think I'll agree with Rajaram. Like in a private equity kind of a thing, they are not bothered about these things. They will probably ignore, because of the life cycle is 3 to 5 years. Whereas in a strategic one, this plays a significant role, and we know, as Jayashree mentioned, it was a strategic deal where it fell through because of the disagreement on this point. But yeah, I mean fundamentally yes, it is deferred tax liability would be debt-like eventually. I mean, if you keeping everything aside, just what does it mean, right? Eventually you'll have to pay the taxes later, whenever it happens. Deferred tax asset is that you are saving the tax. So technically speaking, yes, it is like a debt-like and a cash-like item. But depending on the scenario, whether to take it or not, it purely depends on financial as well as
So
strategy.
basically what we are concluding is deferred tax assets or liabilities is a negotiable item always on
Yes,
the
it
table.
is.
Yes.
And depending on the banker's play, if he's on the sell side, he'll say direct tax asset is cash like.
Yes.
And if it's a DTL, he'll say no, this is not a liability that I should take care.
But I think when we draw the shareholders agreement at that point in time, certain specific indemnities and all can play a role there to address.
No, but I don't think,
this.
I've never heard of, again, we can clarify, I've never heard of indemnity against a direct deferred tax liability. It never comes in because it is an accounting kind of timing gap between your tax payments between the two books. It's nothing else.
Okay.
Coming to the question on FDD piece, Rajaram, what is that one thing that you find in an FDD which you tell your client just run away from this transaction? How much ever interesting it might look to your clients?
It's purely from a financial DD perspective. I have to tell it has to be like if we believe that the books are not reliable and it's like totally cooked up, right? So then it's a big red flag for somebody to kind of stop there.
But how
and
do you
there itself.
catch a cooked up book?
Yeah.
Unless it is not well cooked, right?
Yes, definitely. So I mean, if you get that sense, right? I mean, of course, we are not going with the intention to find frauds or things like that. But many a time we see, right, like in the books, what MIS talks about or what the management keeps talking about in their IM or anywhere else. But what we actually see in the books, it could be very, very different. And many times it is so badly done also, you can also find out. So it's like, yeah, if you said, if someone is very ingenious in doing it, then maybe, yeah, it's a lot more difficult. But somewhere if it is identified, then it's a definite no-go, right? Because nobody would want to go and just take on
So
such
in
kind
some
of
it
risk.
is misreporting.
Yeah, misreporting is one definite. Other ones are like, things like, if someone has done the background check and then if something, something which is found out about the promoters or the business itself, then, we have seen such kind of cases where, based on some kind of background check it is done, the deal fell through because, somebody had raised a red flag, about political affiliations or, the certain payments which were made, which was not acceptable, etc., etc. So it depends on what is that, critical factor which needs to be ticked or not ticked for the, client. That's what determines, the deal is a deal breaker or not.
And how many times has it happened that you found something which is of the magnitude that you're stating, but the deal still went through?
Yeah, it has happened. It is a commercial call. We have seen such kind of scenarios where even after knowing certain big risk, which we think is a big risk, they have still gone ahead and done it maybe because of some strategic importance which is there for them, and they believe that whatever other things they can set it right and take that in their stride.
We'll move to a different subject which is of most interest to India right now and has been for the last 5 to 6 years, startups, right? We have heard about startup raising funds, we heard about venture capitals coming in, number of venture capitals are going up now. Typically this question always comes up as to how do you advise a startup versus how do you advise a bigger client, right? Let's do this round once from the starting process again. Jyotirmay, you can start with your views as to what are the few things that startup needs to keep in mind and keep its tap, house right to be able to be funding ready and to be able to scale to the next level as far as M&A is concerned. When I say M&A, it's more like going from early stage to growth, the kind of funding that it needs to raise. Should it get prepared from, and we'll have to touch a little bit of finance and accounts over here because we have a room of chartered accountants here.
Yeah,
What is it that you're seeing that startups do it wrong, which they should do it right to be able to be funding ready?
No, so, okay, look, what it was 4 to 5 years back versus what it is right now, these are all like, we are in two different worlds, okay? 4 to 5 years back, I mean, during COVID also, okay? And look, sorry, I'll just, sorry for digression, but I have always seen VCs in India are very driven by a herd mentality. So there is a wave of aggregators that had come. They will keep saying that no, we are analyzing, but bottom line is if Sequoia is doing a transaction in US, I can do a one-to-one mapping right now of, if you see the Y Combinator list of which are the startups they are funding in YC winter batch of 2025, chances are that similar startups would be funded by all the other Indian VCs in the next 7 to 8 months. Okay, so it is, first thing is just to be in your early stage. You should be very clear about your sector. You have to be at the right place at the right time and say the right things. But post the first initial round of funding, if you can make it through the accelerators and if you can get a proper VC to write you a small 200k, 300k check, but it is still coming from a Sequoia or a K-Start or somebody like that, which is considered to be recognized to be a talent scout in the industry. Then it becomes a question of you showing solid unit economics. Okay, your customer lifetime value to CAC should be demonstrably a good number. You should show why your CAC should customer acquisition cost is basically the cost of acquiring any incremental new customer, whether it's for a business to business company or for a business to consumer company. You should be able to quantify and qualify, showing results as to why you are saying that today my CAC for getting a customer is 600 rupees. Why should it fall to 400? There has to be a clear path towards that. It cannot be कि Google में ज़्यादा ऐड करेंगे तो वो ऐसे, that is not accepted anymore. Similarly, lifetime value. How I am going to make the current set of cohort that I am acquiring, the current set of customers that I am acquiring, let's say their lifetime value is 1,000 rupees. Why this 1,000 rupees will become 2,000 rupees? What am I going to sell them more? What am I going to sell them multiple times? Okay, that finally will result in you having a positive unit economics by the end of second year. And you have to show positive unit economics.
So all the numbers, all the definitions that you're calling out, or say CAC or lifetime value, inherent use accounting records or financial reports itself to help them build the math. For example, cohorts, it's a math of revenues, gross margins, and the way number of user retention or customer retention. How it plays out. Your CAC is a math of the way you record your marketing cost, how you bucket it between branding, marketing, and number of new user acquisition. There is no practical or a theory there which is standardized, and it differs from business to business. So as a startup, and if you're advising a startup as an accountant, or you're running, helping them with their MIS preparation, it becomes a big challenge at times that I think, I'm not sure if any of you actually help startups build their MIS, because a big challenge is definitionally how do you actually make sure that the definition is coming out right, and the way it gets read by the investor as well, because what you're stating is like for example Rajaram comes in, right? He looks at the MIS, he looks at CAC, and if imagine the accountant has advised with a definition of CAC to the startup, and startup founder is a techie, he doesn't understand any of it, and the definitionally the CAC that he's reported is very different from the way the VC looks at it. Given that there's no standardized definitions.
Absolutely.
How does it play out in VC's mind? Like what exactly should accountant keep in their mind? Where should they actually learn? How should they actually get that knowledge to be able to rightly represent businesses MIS as led by the VCs?
So somewhere, and forgive me for saying this, I mean all of us we get too bogged down by the standards that has been set by some Italian who had started double entry some 500 years back, and we put all those things in those boxes. The bottom line is that the CFO or the accounts person needs to just see that see things in a very simplistic manner. For example, branding. Okay, there is no set rule, as you said, right? If I am selling a consumer brand like a jeans, my branding is a part of, I mean, it may not be directly proportional, like linearly proportional to my number of customers, but at the end of the day, it's a customer acquisition cost, because I am wearing a brand of jeans. Otherwise, I will stitch my own clothes and wear it from Chaudhary tailors, right? Which is not going to happen. Now, but on the other hand, when it comes to a B2B business, right? So, if I am doing advertisement, above the line advertisement, should it be a part of my customer acquisition cost? Maybe not. And so when you are drawing a P&L, because first of all, when the CFO sends the P&L, look, I mean, the moment I send a signed financial to an investor, that document is going to be the datum document. That's the point from where we start the conversation. So if you have already entered into the game on a sticky wicket, if you have shown everything, like let's say everything is a variable cost, then that means that there is no scope for you to reduce the variable cost even if you scale up, because the variable cost will keep on increasing like that. So if you have already in your financials shown them in some fashion, which implies inherently, when I first read the document financial, there is a variable cost, then you have to start your discussion justifying why it is not so. Vis-a-vis, if I represent it in a manner which is, despite the fact that it's a marketing cost, I showcase that I introduce those elements: contribution margin 1, contribution margin 2, etc., gross margin. So these are all, contribution margin 1, contribution margin 2 is not an accounting thing, right? But I don't think so anybody is going to stop you from showing it in your financials if you are the CFO of the company, right? Or if you are the auditor of the company. It's not wrong. It is just a different representation. So represent it. Start from that wicket so that we are in a strong position. We should track our accounting outlook, should be the showcase of what we want to show to the world. And let the world come back and argue that. Why take a position where we have to argue and justify our position rather than the other way around? I don't know whether I made sense to you or not,
Made
but
sense.
yeah.
Made sense. It's more, what you're saying is the stat audited financials itself should actually represent the MIS in many ways,
Yeah.
so that it comes out very clearly, evidently in the
Absolutely.
itself. How about tax, Aditya? Like startups typically in the first many years make losses. There are no profits. So logically, everybody says there is no direct tax implication there. What's your thought? Like typically,
Yeah.
where do they go wrong in that particular thought
Yeah,
process?
I think I'll give you one, interesting, what we've seen is, I think most of the startups have been started by the IITians, right? All the engineers, okay? For them, I think the compliance is not there in their world, first to start with. When we tell them there is compliance, then they will start thinking, oh, there is something like this, okay? So when you enter into a startup started by a brilliant IITian, the compliance status will be, you'll be scared to even go to meet him again, right? So we start from that level, saying that, okay, sir, you have, okay, no profit, but still there are these 100 things you have to do to start with. So they don't know about withholding tax, a salary or whatever, like, simple things. They will, I mean, it's not that they know and they don't do, it's that they don't know. Unless and until they get a finance manager, until that time they don't have funds, so they will not do all these things. But then we start, kind of saying that, okay, first you have to do these compliances, and that has become a big issue in all startups. But now I think it's more or less, now I think they are kind of, they know that, okay, this will be a big, kind of a bottleneck when actually the funding or, because in due diligence, everything will be highlighted, right? From the, withholding tax or GST non-compliances, returns, income tax return. We have seen a lot of companies have not filed income tax because they don't know that this has to be done. Withholding tax returns, not filed, nothing. One company, they started developing the IP which was registered in the name of the promoter. Okay, it was not in the name of the company. Then suddenly the deal discussion started. Okay, where is the IP? Oh, it's in the name of the promoter. Okay, now, and in his mind, okay, Mera hi company, I'll just transfer it. He said, okay, boss, no, that will not happen like that. Then, so that kind of things, it is unfortunate because the ideas what all they come up with is brilliant. I mean, no one can match, right? But compliance side, it's like, complete black hole. We don't, it's really scary. So what we used to do sometimes is that, okay, for few years just handhold them. Simple things, right? Like for us it is day to day, but for them it is new, but at least handhold them till they reach a stage where they have a in-house, maybe a CFO or someone who takes care of all these things, and then they can run, on their own. So, but having said that, yes, I mean, compliance in the startups had been a big issue, but they have actually, kind of, moved along. I mean, now if you look at now the latest startups and all, I think they are fairly in a good shape as compared to the ones which had started maybe a couple of years back.
Jayashree, any thoughts from you?
No, I echo what Aditya is saying. So I think if you look at diligences that we did maybe 4 5 years back to now, I think even the buyers are a little more mindful of compliances in the startup ecosystem as well. I remember 5 6 years back when we used to do diligences on startups, it was more a tick the box. Even the buyer knew that there are going to be issues, but it's okay. They're buying it more for the whatever the idea and the thoughts rather than the compliance front. So nobody really cared too much about it. But recently, in fact, I had a conversation where the client came to us asking us to do a health check because they were preparing for a fundraise. So I think they're also getting a lot more aware these days. So I think that's where we have a role to play in terms of educating them and ensuring that they're, ensuring all the compliances are there in place.
And as part of your startup, because I'll cover the tax question that I have in my mind, is typically when a startup is raising funds, right? The VCs are based out of India or based out of other geographies outside India. There are few sectors which have an FDI related issue, right? For example, e-commerce. If you're on a marketplace model versus a inventory model, there is a big differentiator. Should you raise it from the VCs outside India or India, or should you dilute it to? So, are there any other sectors which are sticky, where it becomes very important for the startup to keep an eye if it has to be? So, which geography VC should you, or which geography investor should you actually go and reach out to?
I think, one is definitely the e-commerce. I think somewhere there is a little bit of gray area in the retail sector because,
Multi-brand.
multi-brand, correct, multi-brand one, because there is, we know that some of the law firms have taken a view that, okay, this is not a multi-brand and all those things. But that's one, sector where we are a little careful when there are foreign funds involved. In terms of the jurisdiction, again, I think I would say because of the Press Note 3, the neighboring countries, we are a little careful about, we go, I mean, it's not a tax issue, but it's just a deal issue, like to say who's your ultimate beneficial owner. And you don't want to be in a situation where it is from a neighboring country. But I think apart from that, I think it's fairly sorted, like fintech and all those things are very sorted, guys. I think, the rest of the sectors are still okay, except for maybe the e-commerce and the, the multi-brand retail ones.
Now mostly we have 100% FDI
Yeah.
sectors.
Rajan, coming to FDDs on startups, right? Typically what happens is when you try to go and help a startup in a financial diligence exercise, you find that data is not clean, data is not maintained. Half of the things are just numbers reported without any backing data. What kind of feedback do you typically get from the investors? Because that might become like an important insight for people who advise startups on the accounting as to what do you get back from the investors when they see you reporting to them that the startup does not have backup data. What kind of
I think it also depends on at which stage the fundraise is happening. For instance, right? If the seed fund or the Series A, maybe some of the data limitations, investors also would know this kind of as Jyotirmay explained, like they are like all technical guys and their focus will be all on development of the product which they are trying to sell, rather than there will be a lot of housekeeping issues in any case, including the bookkeeping, right? But if somebody is having similar problems maybe in a subsequent rounds also, then it's a kind of concern, right? That obviously you have gone through a couple of rounds of diligence and then you're still having a lot of these issues. Maybe it's a concern. So it can lead to a case where investors can get a little uncomfortable with that fact. So that's what I feel, and I'm sure you have a better understanding of this considering the number of startup DDs you do.
No, that's true. That's fair. The most important thing that the VCs also want us to double click on is there an integrity issue, or is it actually truly a data sanity issue? Is there a workaround that they can get a comfort on that particular number? Does that math make sense? A lot of sensitization happens when what gets reported versus what gets digested by the investors. I'll open the floor for questions if you have any. We have 15 more minutes. If you have any questions, we can take those, or I'll continue with my Q&A.
So these days, startups tend to raise funds through SafeNote from Yeah, safe note.
Safe.
Yeah,
Safe.
simplified argument. So there is no regulation currently in India which ideally actually governs this from at least from an income tax standpoint. So is this something you have come across, and is it allowed or not? This is again flowing from US. The concept is from there.
You mean just safe notes?
safe
right?
notes,
Oh yeah. So there's no regulation as such,
Right.
and it doesn't because okay, and again from a tax perspective it doesn't matter. It more from a FEMA perspective. I think FEMA has not gone to that level, like, because as long as it coming from like a jurisdiction which is not tainted, I think that should not be an issue.
But then the valuation, how does the valuation happen in that case? Because the fund comes in today and the equity depends on the future event. So
No, sorry, if you can just
yeah, so what I was trying to say is that the fund comes in today and the valuation will happen at a later stage because when it gets converted. So under FEMA, is it allowed that you receive the funds today and you do the conversion at the later stage?
See, you will, okay, what happens is the FEMA rule says that you cannot, convert it at a value which is lesser than today. Okay, so you can convert it at a value higher than, today. So what does that mean is, if your value is say 100 rupees today, if you are converting at 200, that's absolutely fine. No one will, kind of question you. And typically these guys will have that kind of a thing. You will never be able to convert it below 100, come what may. I mean, even in the future. But
So
if it
even the investor may not be ready to convert at the below
Exactly,
value.
exactly. So anti-dilution will not be there at all. So that way, then from a FEMA perspective, it is safe. As long as you don't go below 100, that is the value at which you have issued today, that should be fine. That should not be an issue.
So we don't need a specific RBI approval or anything? Because
No, not really. No.
Any other questions?
Probably this is off topic. My question is, how do the medium-sized practitioners scale up this vertical, and what would be the skill set which is required, and what should they look for?
For startup vertical.
No, as a practitioner for
M&A.
M&A vertical.
We'll start with IB because that is where the actual money lies.
No, I mean, okay, I wish what you're saying is true, but
yeah, actually even I don't know.
yeah, but look, I mean, I just, it's not a very, how to put it, it's given the fact that 60 to 70% of the work from an IB standpoint starts with a combination of relationship and understanding of a particular market, right? It is a very people-centric thing. If there are two partners who can work in tandem and can get 2-3 people to be really capable. So at a partner level, if you have some standing in the market, if you can go and talk to 10 different people, you can identify the sectors. Deal flow is not that big a challenge. The issue lies in the eventual conversion, etc. Right? So if you mean how we start a practice, how you start a practice is to start it with none of your existing clients, if they are reasonably big enough, will say no to money coming in, or will say no to money coming in into the company or to the shareholders. So it is upon the partners of the existing firm to identify which are those two horses that you want to bet on and kickstart the practice. The rest of the ecosystem is available. See, honestly, I mean, the moment he asked the safe note question, had it been addressed towards me, I would have anyways asked Aditya to answer it. I mean, so you get a good ecosystem of people who can support all this. But to kickstart the process, you need to have those industry relationships. So if there is a vertical focus, it always helps that you understand real estate or technology or something like that, which is broad enough. At the same time, not many people can really talk about it. So I think that's all from my side. Aditya.
Yeah. No, I think I completely agree, because somehow I think we were also debating, like, what is it that, some of these professionals in the market are, like they are individuals and they have done really well, right? What is that
that differentiates, and they are like as big as anyone in the country, right? So the things, what we understand is that the core competency, like, you know, you focus on something and you should be known in the market for that particular thing. Like say, you know, FEMA, okay, FEMA, no one else in the, you know, in India, you know, who can guide me, this person. So it is that kind of a knowledge and you know, kind of competency what you develop will definitely will differentiate, and it doesn't matter, then there's no competition in the market for you. So it's main of that, you know, the competency where you can build and you know, market, and definitely the relationship. I mean,
The way I put it, right, it's very, so there are 4 typical teams in an M&A practice across the firms where their M&A practice is. The first one is called corporate finance, which houses investment banking. The second one is valuations, which again is a subject that we discussed, touched upon multiple times today. The third is transactions, which has again, you have diligences plus post-merger integration, which is like the transaction related advisory. And then you have tax. Now, if of the 4, right, the first one, corporate finance, it can be anybody. I know a lot of my friends who have gone solo, who were previously part of another investment banking firm, now gone solo, set up their own practice. I have done revenues in the quantum that probably at times a corporate finance team in a big 4 also is not able to touch. They've gone solo and done it. So it practically doesn't matter for them as to what kind of skill set is required. As long as they are deal makers, they're able to identify 2 targets for a buyer and then try to stitch to the deal, they are good. If they have the capacity to have a good ecosystem connection with respect to VCs and private equities, and they get a good lead of targets or the startups who come out to them for fundraisers, they make their money. So corporate finance typically is very easy entry point for any mid-market firm. And that's my take. Second is valuation. Typically what happens is valuations are required for multiple purposes, be it statutory compliances or internal compliances, right? Statutory compliances, it doesn't matter, you all already will be helping many of your clients with your valuation support. As far as your internal compliances are concerned, for example, a private equity wants to do a valuation or a corporate wants to do a valuation. Unfortunately, their brand comes to play because their board might have certain, again, external foreign investors who cannot trust a name that they've not previously seen. It becomes very tough for you to crack that market unless you get together and establish a brand. Like none of the big 4s or big 6 or big 10s were brands created from day one, right? They were all different firms which got together to create a bigger brand. So there you need to have an association of bigger brands coming in. Same thing applies to due diligences as well when they come to the transactions part, because again over there who's done the diligence becomes very important, because there are people in the investment committee of private equities or VCs and also the board that is very particular about. Tax, again, people go solo. Mid-market advice is considered good if the name is big. I was recently on a call 2 days back, and the name that was being quoted as, it was a tax opinion taken from Mr. Kincha in Bangalore, and that was being quoted on that particular call that it's a reputed, and it's a mid-market firm, right, mid-sized firm. But the name, brand name has gotten established for tax purposes, and that is being called out on a official call. So you can imagine. So I feel the first and the last are 2 places where mid-sized companies can certainly make it, while in the other 2, valuation and transactions, while it can be done, there are many firms which are helping out. We have seen the reports. Frankly, I'm sure Rajaram also would have read a few reports which are Big 6 reports, and the quality of diligence over there is actually very bad. So the moment we get to see that report and we see that the quality is so bad, imagine a guy who would have invested into that business after reading that, because none of the red flags were highlighted, none of the items were highlighted. Due diligence in particular is a very different, it requires a very different thought process and mindset that Rajaram also is calling out. So it's always, that is best kept out, but the first and the last is where mid-sized companies can go in. And I think skill-wise, as Pramod you asked, skill-wise I don't think there is any differentiator. We have all learned the same subject. It's just that practical application of it is what the differentiating factor is.
We spoke on inorganic growth, organic growth and inorganic growth. Inorganic growth, what it means, why it's important?
See, a company may have a strategy, like just to give an example, right? Like say, I think even Jyotirmay touched upon in some of his slides. So assuming that, so you are currently having a business which has a, full presence in India, and now you want to say establish, say in Australia or US. So you want to establish there. How do you go? And you may have to do it if you do organically, it might take several years for you to build a brand after going there, establish, and it's not going to be easy, and it might take several years and you may not have that kind of time. And whereas you have an aim to go and do it faster, so that's the only best way to do it is through the acquisition route or through investments and find an associate, etc. It could be not only this, even other things, right? Like say you have a product or a business which is reasonably doing well, and you feel that there is competition is coming up, and then you can still organically grow, but if you let the competition thrive and survive in the market, maybe you are not able to improve your market share, or in fact it can come down also. But you can be very aggressive, and you can go and take over that competition itself. In fact, which many of the we see this, many of the big firms do it, or even we keep seeing this in the tech side of it, in the US and things like that. When they see that any potential firm can come and threaten them, so they'll go and acquire them. Even if, for instance, in the tech field, even a startups, for instance, which they feel that that can actually become tomorrow a giant and try to kind of affect your business, they'll try to nip that in the bud only and then acquire that with paying heavy price at that point in time. It might appear heavy at that point in time, but you are basically doing that inorganic route just to make sure that that comes into your fold and no more competition for you. We would have seen that in Google does it, or Facebook, or all of these guys, big guys have done that. That's how they remain in $1 trillion club, and the rest of them don't reach there. So there are hundreds of such examples why inorganic route is required, either to prevent somebody from reaching your stage, or you grow faster than somebody else, or it could be even adjacencies, like your products are there and you need another product to complement it, but you will take more time to develop, or you don't have the capability to do it. You just go and buy someone who has already done it that way.
To add a joke to it, love marriage versus arranged marriage. Love marriage is organic, arranged marriage is inorganic, right? You can't keep spending time to find the best one, so you go in the inorganic way. So that's how it works.
Yeah.
It typically is to make sure. See, at times time is the biggest factor. At times capability is also another factor. You don't have capability to get into a market, you go inorganic. You don't have capability to build a product, you go inorganic. You don't have time to build a product, you go inorganic. It's about scaling without spending that or that effort that is required for it.
On the indemnity, this is on the indemnity. Even though we have indemnity, we can't write everything into the WAD at all. So what is the key thing need to be in the indemnity? Something, even though in the indemnity we get it from the seller, something will not work. Those kind of practical situations, if you have, you can share.
Yeah, see, as I mentioned, indemnity is a very fancy word, right? But not many people will be ready to give it, because it is a big obligation on the part of whoever is giving it. In M&A deal, it's seller who is giving it. So naturally, nobody wants to keep it like very open-ended or a very general. So while certain general indemnities are given, where they believe that the risk is generally lesser, so right. But generally, you try to pinpoint and keep it to the specific indemnities only, and wherein certain risks are specifically identified. Say typically, say tax risk is identified, some specific tax risk is identified, or some legal team would have identified certain case or some litigation, etc. So instead of directly doing the value adjustment, you say, okay, I'm not going to do the value adjustment at this stage. This is on the assumption that this will not result into any cash outflow in future because of this. So only for those specific items you carve out in the transaction documents, so that if it comes, it is done. And seller is again not going to give it unlimited period of time. So they'll normally keep a time period, like okay, this is 18 months or 2 years, whatever period they will agree, and till that period only that indemnity will be valid. After that it will lapse.
You hold back cash as well through an escrow mechanism, that if They don't pay 100%, they hold back cash. I've seen many of the deals where specific indemnity cash holdback is big, deals have collapsed at the last moment. The risk is high, the sellers are not ready to give the indemnity, the buyers can't invest unless the indemnity is received. So deals have collapsed because of this disagreement, which is at the last stage, because all of this discussion happened at the last moment, and at times Jyotirmay calls me and says last moment deal gir gaya, because things like these which are very sticky, it comes to at the end of the day ego also, that I need it, he says I won't give it, and they say okay, let's just call it off.
So
As I said, right, it's very people.
So nowadays, in deals in India also we're seeing tax insurance coming up. Earlier it was not very common that people used to take tax insurance, but now more and more there are people ready to give that tax insurance against the indemnity. So there are very specific aspects where you can take it. It's not open-ended in that sense. But yeah, that's also something that
people are doing these days.
One thing to Jodi, on this Twitter purchase, are you saying it's a good deal or a bad one? Why?
I'm sorry, I have no idea. Way above
No, it was
my
bad,
pay
it has
grade.
become good after Trump came in.
Way above my pay grade. So I don't know, and I honestly do not.
Okay, go ahead.
Consumer tech is something which is a different animal altogether. Everybody has an opinion about it. It's like food bloggers, right? You will find a zillion of them on Insta. Everybody has an opinion about food, but that's the reason why it is one of the least successful. If you see the ratio of the food businesses that succeed versus those which do not, that ratio is like the most widest in food. Something that you, I, all of us think that we know the best. So social media is like that. Everybody has an opinion, but they better keep it to themselves.
Yeah, hi. I have a question on the non-sexy part of the operations, which is post-merger integration. We didn't get to speak much about it. I've worked in a couple of entities where we go in and then try to realize the value or strategies or what you call synergies that were planned, right, as part of mergers and acquisitions. And that's where the challenge starts, because you are promised the sun and the moon, and when you try to kind of earn those synergies, it's very difficult when you're on the ground, and it leaves a lot of pressure and burn rate on the management team that is working on it. Does that feed back into this loop to say, hey, next time we get into a deal, we need to be more realistic in our expectations, because it's like everyone wants the sun, but it doesn't materialize, and I think 90% end up probably not achieving the objectives, right?
Sir, I'm sure you're married, right? Before marriage, you promised sun and the moon, right? But in actually, so jokes apart.
No, indeed. I think
that is how unfortunately things are. But the post-merger integration is one of the, and I'll cover, and then Jyotirmay you can also add, is a very important factor. Not that synergies in 100 like all the transactions don't fail. 90 out of the 100 they try to still draw a lot of synergies. Probably not 100% of what they would have put on the paper. Because at the end of the day, the kind of future outlook that you need to have, the synergy play, it's all people driven and process driven. At times they go right with the thought process of people, but they go wrong with the processes, or vice versa. They might say the processes will fit in, but the people don't fit in. Every business is dependent on either of it or both of it. So making sure both of it work the way, you need to have that mutual kind of value creation that needs to be generated. And hence, if and when Jyotirmay advises also of the synergies, when he points out synergies, he's right at pointing out the synergies. It makes sense at that particular point of time. Unlocking that synergy is the responsibility of the acquirer and the buyer to sit down together to create value for themselves. At times what happens is at that juncture, post-merger or post-acquisition, that particular outlook fails. A lot of factors come into play which might not have come into play when they were evaluating, which result into a loss of synergies. But if you say, does a synergy does not work out at all in a post-merger integration, I would say that's a wrong answer. It was the scale at which it was foresaw, because at the end of the day somebody sold that deal also, and he's shown them sun and the moon, but when actually it comes onto the ground, it's just a bulb and a tube, right? So that's how it works. Jyotirmay, if you want to add something.
I mean, I echo the sentiment entirely when it comes to PMI post-merger, but even before that, when the transaction is on, I mean, when the transaction is yet to be over, right? When we advise sellers, of course, we also go aggressive and we say some stuff. We also sell, not always. And we try to mute the expectations, but sellers always come into a deal being very pally with the advisor. It always starts in a very nice, good note. Okay, we are all joined, a team, etc. I mean, any transaction when it goes into specifically into DD, post DD, SHF phase, the expectation starts facing the reality. Things starts getting muted. But by that point in time, two things can happen, right? I mean, one thing that surely happens is the relationship between the seller and the client and the advisor goes downhill, okay? But at the same time, I think more often than not, if the seller or the buyer, both parties, if they're rational enough, they also know that now that I have spent 6-7 months into the transaction, I need to rationalize my expectations from both sides and leave something on the table for either of the two. I think managing that part is the key to the closure. As Rahul, Raja, all of them are saying, right? I mean, things like people prolong a deal by a month due to fighting on specific indemnity. Something as, I mean, I'm not saying it's not stupid or silly, but it is not so big a thing in the greater scheme of things, right? It is important, but not so big. But by the time they are done with the fighting about the specific indemnity, it's already February, which means the buyer's board will come and say, now that it's February, why not wait till 31st March, see whether they have achieved the projection, and then the deal never happens. So even before merger, a muting down of expectation should happen. More than does it happen? Yes, and it should happen. Otherwise, deals will never happen.
See, for a tech-driven startup, its valuation is primarily driven by the IP. And in the initial stages of growth, they may not even have revenue. Founders typically want to know how do you do the valuation IP of a particular IP so that how much they will be able to dilute when the fundraising actually happens. So how do you really do the valuation of an IP of a startup?
So I'm assuming it's a question primarily for me, and all of you can chime in. Look, there is no valuation for IP. Let me put it that way. First of all, the number of startups which are really, technology especially, which are really into quote-unquote IP are few and far between. I mean, what is the IP in creating a good expense management software? Tell me that. I mean, there's nothing, right? What is the IP? Few startups are there which are really into IP. Somebody is creating a new algorithm for identifying faults in the network. Maybe there is an IP. Is there any way to value it? Absolutely not. So usually all the transaction doesn't even happen with a discovered valuation. The discovery process will happen later. So they will do usually they will issue convertibles, etc. It's more like tranche 500K, 1 million kind of funding to see at least if really the product is good, the founders are good, there is something here. All the VCs would put in some amount of money to see up till the product market fit is established. Then the revenue actual valuation comes in. Before that, these are all convertible notes that you issue, where the actual pricing happens once the bigger round happens in Series A, 2 to 3 million and so on. So that's when the pricing happens. And by that time, revenue should kick in. I mean, there can only be 1 or 2 cases where revenue doesn't kick in forever, but still they are getting funded. But 99.9% of the cases, post the initial round, which is all based on how good a salesman you are and what a great vision of the product you are showcasing. After that, it really happens on the basis of revenue.
And frankly, I've never heard of a private equity or a VC trying to peg a price
Not
to
really
a
private
volume.
equity. Even it could be even angel investors also, the early stage investors.
It doesn't matter. So as Paul pointed out, right, nobody actually bothers about IP valuation. We know of billion-dollar, like Indian unicorns, product companies, which is SaaS businesses where product is the key. They never capitalize anything in their lifetime.
Right, typically expense it off.
Everything is expensed off.
Correct.
And even when they have their conversations with the investors, nobody asks. All that they ask is where the IP is sitting, as the whole algorithm, if it is safely kept, because it's a product-driven business and it should be kept safe. And where is it actually? How safely has it been kept? Other than that, few of them actually go and try to get IP rights also attached to it if it is applicable on that particular product. Otherwise, it's agnostic. Any other questions, or should we wind up for today?
Yeah, first of all, thank you to all the speakers for taking your time out and then doing this. And it was definitely an insightful session. And mainly this panel discussion, it was good. I mean, helped us to understand practically some doubts here and there which were there. All those have been clarified. Thank you so much. So I request our treasurer, Tuppat, to hand over a memento to Rahul Arora, CA Rahul Arora. Request CPJ and MC member to hand over the memento to CA Rajaram Pai. Tuppat, can you please hand over the memento to Mr. Jyotirmay Bhattacharjee? Jyotirmay, I should acknowledge that you never look like non-CA in the group. While you said you are the odd man out, you spoke. Yeah, but you spoke like a CA only. We didn't find any difference. So, yeah. I request CP Jain to hand over the memento to CA Aditya Narvekar. Tuppat, one more round, please. Yes. To CA Jayashree S. Thank you, Jayashree, for being here with us. Yeah, I once again thank you, all of you, for sharing your knowledge with us. Thank you so much. At the same time, I would like to thank all the audience and participants. Participants for registering. It was, and I hope all of you will definitely say it was a day well spent and learning with a lot of learning. Thank you all. So, thank you. And group photo. Yeah, I'll tell them. I'll finish, first of all, sorry. And thanks to all the audience and participants. At the same time, I would like to thank Marriott for giving us the space and the food for the day. Very good, very well done. And to the photographers and the AV Council for handling this show. Thank you. Thank you so much. And we'll see you next week with a new subject. Yeah, thank you so much. See you next week.